Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us today. It's great to have you all with us. Our goal with FounderLine is to provide a way for people to get their questions about startups answered by experienced entrepreneurs and investors. Maybe you're thinking about starting a company. Maybe you've already started a company and you have an issue that you're dealing with. Maybe you're thinking about joining a company and you want to know more about the company that you're joining, and you might have a question about that. So whatever it is, we're here to help you today. This is a live show, and the only way that this works is if you interact with us and ask us questions. So you can do that by email. You can send us a question to help@founderline.com. You can also tweet your questions to @founderline, and we'll see if we can help you out. With that, let's get started. Our guest today is Bill Trenchard, who's a partner with First Round Capital. Bill's founded a number of startup companies, including Jump Networks and LiveOps. He's also invested in a bunch of amazing startups, including Uber, Ironport, Lending Club, and Tapulous, amongst others. Bill, welcome, and thanks for joining us today on FounderLine.
Oh, thank you for having me. It's great to be here.
It's great to have you here. We're having a little AV issues, so bear with us if we have any weird things going on. But usually the way we get started is we just chat for a few minutes,
Sure.
ask a few questions. And for those of you who don't know, which is probably everyone, Bill and I go way back to the late 1990s with what I call the great calendar war of Web 1.0. Bill was the founder of a web calendar company called Jump, and I was one of the founders of another web calendar company called When.com. And maybe you can walk us through a little bit about that story and how you got started in technology startups. And I think we discovered that we have a mutual friend who might have been part of this story as well.
Sure,
so,
yeah, I'll give you the brief version. So I went to school in upstate New York at Cornell and started a business there that was basically building web software for other people in the early days of the internet, 94, 95, 96. Back when everyone needed web software built, there weren't enough people to do it, and they didn't care that there were college students building it.
Yeah.
And that business we did pretty well. And I started to build a network of people out in the valley, and I started to connect with people. One of my team members went to go work at Yahoo, and after I graduated, I wanted to build a product. I didn't want to be a consultant anymore.
Got it.
And so that was
that drill.
Yeah, and so that was a critical shift. And we started working on the Palm Pilot back in the day. So there was back in the day the Palm 5. Remember hot syncing? I tell the kids today that have seen it.
What were you were building software for that?
Yeah. It was basically an offline web browser. So the idea you could hot sync your news and all that stuff down to the Palm and then take it with you for the day.
Like there was AvantGo was one of those.
Well, that's one of the reasons I pivoted. So we had this idea. It was very Pointcast-like. If you remember Pointcast, you'd sync, you get your news stocks and all that stuff. AvantGo launched with a bunch of venture funding out here. We were some kids out of Cornell. I said, I'm out of luck. And so I called my friend at Yahoo and said, would you guys have any interest in buying this? He introduced me to a guy named Jeff Ralston. And
who's been on the show?
Who's been on the show.
He's a great guest.
He's a great guy.
Is now at YC and
as a partner at YC.
As well as Imagine K-12.
That's right.
As he always reminds me.
So I met Jeff, and he said, we love all the stuff that you're doing on the Palm, but could you get the stuff that's on the Palm, the calendar and the contacts and all that stuff, and get that synced up to the web and build an experience around that? And so that was the beginning and genesis of Jump. I always like to tell entrepreneurs, get out and know your customer. I had a customer one, which was Jeff at the time. But at the time, Yahoo was certainly the top internet company. And he knew what the next wave was going to be.
That's cool.
So
what year was that when you were?
That was 98, early 98. Yeah. And then we built it. And ultimately, Jeff really just wanted to buy the company. And I think he was probably talking to you guys at the time, too.
He was, in fact. And I think we can probably share this now. But they tried to acquire us. I'm trying to remember. It was like spring of '98.
Yep.
And it was Katie Middick, who was there with Dave Nakayama and Jeff.
That's right.
And like we had just launched. Like I think it was the four of us and maybe one or two engineers, the four founders, and like Yahoo wants to talk to us, and we have this conversation. We haven't even built anything yet.
Yeah.
And they're like, oh, we want to buy you. And,
Yep.
and we're like, what? Like that doesn't make any sense. And
Very similar to us.
yeah. And and then they ended up buying WebCal.
WebCal,
I don't know if you remember that.
Oh, I
which
do.
is not the best piece of technology in the world, but
Yep.
they took that and revamped it. And then, remember in those days, they were all portals, right?
Right.
So every portal needed a calendar,
That's right.
as it turned out. So Microsoft got yours, and
Yes.
AOL got ours,
Yes.
and the rest is history. So
That's how I ended up out here.
well, and it's so funny because the way we started When.com is we had a consulting firm called ActiveSite, and we were doing web projects for a bunch of companies, including Microsoft and Netscape and PG&E, and then we said, we don't want to do consulting for the rest of our lives. We want to build a product. So it was like almost the identical thing. I didn't know that they were that parallel.
Yeah.
And we were competitors, but we didn't know each other at the time. And then afterwards, we did the kind of the postmortem on. So how did your calendar company go?
Exactly.
So that was awesome. And then you went through, did a bunch of companies after that. So remind me of the list. So Jump Networks was one.
I did Jump Networks. Then I went to Idealab for about a year.
Oh, that's right.
So
like
I joined
EIR or.
So managing director was the role.
Okay.
Basically, I was helping to launch the incubator here in Silicon Valley.
That's right.
That was in '99 to 2000.
Okay.
That was a very special time, if you remember.
And Bannister was there, right?
That's where I met Scott Bannister and a bunch of other great folks.
Okay.
And then we. I left there in the end of 2000.
Okay.
And then took a few months off and then started thinking about what to do next. Started fiddling with phone systems and realizing that this was really painful. Started learning about voice over IP. Met a bunch of guys that knew a lot more about that space than I did, and we started brainstorming some ideas, and we came up with a company called Callcast.
That's right.
And Callcast was it was one of these situations where it was a kind of right idea, which is basically building a phone application building platform in the cloud, where you could build apps that would interact with the phone network. It was about 8 years too early. There's a company that's pretty successful now called Twilio.
I was just thinking it was Twilio.
Yeah, that's right.
Well, and that's what's so funny is all these companies are like Instacart, right?
Yes.
I mean, that's
come around again.
Yeah, it's Webvan, and there wasn't an Uber back then, I don't think, but like all these Web 1.0 ideas now that you have this network, they're possible again, right?
That's right. Yeah,
I should go back through the news headlines from like 99, 2000 and see what's going on.
What ideas we can resurrect. Absolutely.
So then, and that ended up merging with Live
Yeah,
Apps.
so it was a tough time. We were building that from 2001 to 2002. 2002 was like very hard to raise any money. We raised a little angel money, but it was very hard to raise venture money. And we were frankly way too early to the market. It was a good idea, but many years too early.
Yeah.
And so we tried to find a way to keep the company going. We met this company called Live Ops that was based in Florida that was doing this very interesting idea around call centers, where they would have people work from home instead of in a center.
Yeah.
And so we merged with them. They really didn't have a technology platform to build on. We needed a business. Peanut butter and jelly came together, and then we moved that company out to California, and I ran that company until 2007.
Awesome. And now, after that, you
started investing.
You started investing, and so
I made one early investment in a company called Ironport, which you mentioned.
That's right. Because of your relationship with Scott, I would imagine,
that's right?
Scott Bannister, who started Ironport, and is now Mr. Angel Investor. He's doing all sorts of stuff right now, I hear.
Yeah, he's doing great.
And then, so that started you down the seed investing path, right?
Yes.
And of course, this is all before first round and 500 startups and YC and all these things existed, right? I mean,
well, first round started in 2005, so it just hit its 10-year anniversary. It was very small then. The seed investing world was still individuals largely. It wasn't institutionalized yet.
And then talk about like how Founder Collective came about.
Yeah, sure. So I started angel investing. Also helped start a couple companies during that period. And then in 2009, a couple of guys I know out of a board I'd been on very early on in the dot-com days, wanted to start a venture firm that was based on the idea being there'd be a good couple full-time guys and a bunch of what they call founder partners who are full-time entrepreneurs or entrepreneurs thinking about doing their next thing or doing angel investing as their affiliates, effectively, similar to a venture partner model.
Yeah.
But everybody involved in the firm was going to be a founder, a previous founder. And I thought it was interesting, so I signed on in 2009 and invested my money alongside their money for several years. And it went well. It was a lot of fun working with those guys. And that was actually the experience that got me to think that I really want to do this full time. It was what really helped me fall in love with investing and that side, being on that side of the fence.
And that's how, I met Eric Paley through you,
yes,
right?
That's right.
When I was doing Tello, and
right.
And Eric, you guys decided to do it. So
and Eric and David were the full-time guys.
Got it. And
on
still
the East
are.
Coast. And still are.
Yeah.
That's right. With Micah now, they brought Micah on board as well.
Oh, great.
Yeah.
I have heard several people say they had really good experiences, and I did as well. So
and the early days were fun, a lot of fun. Chris Dixon was there. Katerina is still there, and they've done great.
That's awesome. So then, a couple years ago, you decided to join First Round.
Yep.
And so you had they funded a previous company of yours, or you guys just knew each other?
So Josh had invested in Live Ops.
Okay.
So we knew each other a lot through that experience.
Got it.
And I unfortunately passed on investing in half.com. But
whoops.
It
happens.
It was
to the
passing on a few of those that my friends did. That obviously I did Ironport, but didn't do a bunch. That really got me to realize, hey, this is actually there's a business here. I didn't really know anything about it, and that's what it was. A combination of that and the Ironport exit that really got me thinking about doing that in 2007, 2008, and that's what that and Founder Collective led to First Round. And so in 2012, I started thinking about doing this full time. I talked to a bunch of people. And I'd known Josh from back when I did my first business at Cornell. So
wow.
20 years now, we've known each other. He was my biggest customer for the web contracting business.
Oh, wow.
And
that's awesome.
And so it's cool to come full circle.
And so what sorts of things are you focusing on now? What kind of companies?
Yeah, we do. So we're broad internet stuff, I would say, generally. We do consumer and enterprise. I tend towards the enterprise a little more, just because of my experience. LiveUps is an enterprise company.
Okay.
I've invested in a number of enterprise companies. My best company happens to be a deal I did at Founder Collective, which is Uber, which happens to be a consumer company, and that has the element of being a collaborative consumption, crowdsourcing type of play, which ties into some of the live ops roots. But most of my stuff tends enterprise, or fintech is another one. So you mentioned Lending Club. We've done a number of things in and around the lending space and financial tech. So enterprise, fintech, and I'd say sort of marketplaces in general.
Cool.
But we tend to, we're polygamists. We'll invest in any great company.
And if somebody wants to reach out the First Round, a lot of times people say, well, the best way is through a warm intro to one of the partners. Is that true for you guys?
That is absolutely the best way.
Okay.
There are a lot of, we do have one of the sort of info at email addresses, and we're doing some interesting work around that in the near future, which I won't spoil here, but you'll see some stuff coming soon from us on that.
Stay tuned. There's something big coming.
But the best way to find us is getting an intro through somebody that knows us. And really, what I recommend entrepreneurs do, and I tell all my entrepreneurs do this when they go for raise their Series A, is understand the background of the investor, what sort of deals they've done in the past.
Exactly.
Do some calls on them, really understand what their interests are, what get them excited, and then find the right intro.
Great. Well, if I need to get to you, I'll email Rob Hayes, and then he can forward it on to you, and we'll go from there. Yeah, that interesting is very funny, because I tell people, if you're doing a sports startup and some VC isn't into sports, don't even waste your time. Like they're very unlikely to fund you unless they see dollar signs everywhere, and even then, pretty unlikely. So
yes,
anyway, well, let's maybe we can see if we can help some people out.
Sure, sounds great.
I'll just remind everybody the best way to reach us is email help@founderline.com or tweet to @founderline, and we'll see if we can answer your questions. So let's dive in here, and Joel, who's in the control room, can send me these questions. So the first one we have is from Richard. It says, as an investor, how do you and First Round deal with something like YC Demo Day? This is actually
very timely.
Where there are over 100 companies all at once. Do you split them up with your partners or focus on certain areas only?
Great question. It is a very unique problem. They had, it's a relatively new problem, right, for us to solve as investors. in investing, you want to get to know an entrepreneur over some period of time.
Right.
And what the YC Demo Day has done is compress that amount of time dramatically. It's such a, it almost feels like a jump ball situation sometimes because
crazy.
it's Demo Day and then term sheets come in for them very quickly. So you have to change your play on the field. What we've done, and I haven't said we haven't, I don't think we have a playbook that's perfected by any means. We send 2 partners to the actual day of demo days. We try to get to the entrepreneurs ahead of time. So we try to just learn at least learn something about them, learn who they are. They're really, some of them can raise before, but they're really not supposed to raise up until right around demo day.
Right.
We funded one that was this year prior to demo day, but we had met them even before YC, so it was sort of
that was the cancer.
Notable Labs.
Yeah, it's a pretty cool company.
Yeah, love those guys. They're doing great stuff. So. But it's a tough situation. What we do is we try to get as much information the day of. We kind of all hands on deck. We changed our partner meeting schedule last week, so we had whereas we normally have a 4-hour meeting with maybe 2 or 3 pitches, we made it a 7-hour meeting, and we slotted in I think 9 companies.
Which day was that? Was that
was
Wednesday?
Thursday last week.
Oh, Thursday. Okay.
Our partner meetings are on Thursday.
Okay,
we have a small one on Monday, but mostly on Thursday.
Oh, got it.
And so we made that YC day basically, and we sort of everybody we liked, and the pitches we saw of the 2.5 minutes, and that we learned information from. You tend to talk to a lot of people in the industry. Hey, what did you think? You're talking to people at demo day. You're talking to people beforehand. We brought into that, and so we can make quick decisions because we are a larger partnership, and so that means that you got to get multiple eyes on a company. A lot of guys are one man shows, right, with a $30 million fund, and they can make point decisions.
Yeah.
So we are disadvantaged in that way. So we had to change our partnership meeting. I think it worked out. It was an experiment, and we got to keep at it. And we ultimately, we love what they're doing. We love YC. We've done a number of YC companies.
Sure.
And we hope we have more successes there in the future.
So without naming names, how many
of them did we
companies will you do out of this batch, do you think?
Well, so we had the one before,
yeah,
and then I think we'll do 1 or 2 others.
Wow. And it's it's in flux. Like I've been scrambling. So I'm one person, right?
Yep.
And just trying to meet all these people, and there is somewhat an expectation, especially for smaller investors who are not institutional. Like there's almost an expectation like you have a 15-minute phone call and they decide like over the phone call.
Yes.
And that's not me.
Yes.
Like I want to have a good relationship with these people, and
Yeah.
I'm sure for you guys,
Yeah.
you want to at least spend a couple hours with them, right?
Yeah.
And so it's a little weird in that it's starting to force this, feeding frenzy. I don't know what the right term for it is, but it makes it really hard on everybody.
It's very tough, and it's particularly tough on your calendar for all the other deals because there's a lot of stuff we invest in that isn't YC. So in a regular week, we're seeing a lot of other stuff.
Yeah.
So it creates this logjam, right? There's only so much time in the day.
Yeah.
And you take weekend meetings and you do what you can to try to make it all work, nights,
Yeah.
weekends, but it still gets pretty jammed during this week.
No, it's crazy, and it's really hard on the founders too, because they get a list of like anywhere I've seen 50 to 150 likes.
Yep.
And then they have to decide, well, who are all these people,
Yes.
right? And
Yeah.
so one of the things that I think they found very valuable in talking to me is like they would pull out their list and we'd go down it,
Yeah.
and they'd be like, what do you know about Bill Trenchard?
Yeah.
And I'd be like, well,
Yeah, don't talk to that guy.
Yeah. No. I said very good things about first round, Josh. Don't be mad at me. But they don't know. And the hard part for me was I didn't even know. I'd say I knew 20% of the people on the list, and that's I thought it'd be more like 50.
Yeah.
But there's so many individuals
a lot
from
of
like
individuals.
all over the world.
Yep.
They're coming in, and so I mean it's great from a like a startup creation perspective, but it makes the process of, and just trying to process. I find myself sitting through those days, and you start to lose track of
Yep.
like time, and you're like, oh, do I like this or not? Because I know if I hit that button,
Yeah.
like somebody's gonna call me. So
It's great for the companies. They are able to get rounds put together very quickly, and they get
It
the
is.
funding. The challenge is, and what I always tell the entrepreneurs is I still think it's very important to have a lead investor, to have one guy with more skin in the game than the others that's going to pick up the phone
Yeah.
when times aren't are tough, and they usually are at some point. You and I have done a number of startups, and they aren't always up and to the right.
They aren't?
Yeah, squiggly lines, and they're up and down, and during those times, having a lead investor who's really in there with you, right, rowing with you, that's important. And what you want to avoid is the total party round, where it's just a bunch of people with 100K checks that aren't really. You're one of a portfolio for them.
Well,
it works or it doesn't.
And in those situations, everyone assumes someone else is helping the company out, right?
That's right. Oh yeah, somebody else has got it. Exactly.
All right. Well, so Richard, I hope that helps give you some perspective into first round and the YC process. Let's go to the next one. This is from Larry. In seeking the proper balance between hiring too soon, which means spending too much, or too late, losing opportunity, and firing too soon, possibility for retraining rather than starting with a new hire, or too late, harming the team. That's very convoluted. I didn't totally understand that, but hopefully you did. Is it better to err on the side of too soon or too late? So does the answer change as the company grows? So in seeking the proper balance between hiring too soon, is it better to err on one or the other, sooner or later?
Well, I think it does matter what life cycle where you are, how much funding you have, how much runway you have, how much cash burn you have.
Okay.
In the very early days, it's usually you and your co-founder or founders taking no salary, working out of the garage type of situation.
Right.
And if you can get other people to jump on the boat and take no salary, that's great if they're the right people. There's a lot in there. I'd say that firing fast is very important. Retraining in a startup, generally, I would say you probably don't have the right person. This is, startups are moving so fast that, if you don't have someone that's just blowing you away and just really, inspiring you to do even better work every day, they're probably not the right fit, and you need to remove them quickly. And they can drag the rest of the culture down. I'm sure you have been a CEO multiple times. You know this. My observation has been when you get rid of the people that are poor performers, the entire performance of everyone else jumps up a lot, and people rise to the occasion, even though you're limited resources in a startup. So I think that's very important. But I'd say as the company grows, you can be more opportunistic in your hiring. Right? We are in the most competitive talent market ever. That in the Valley's ever seen. Yeah. Google, people at Google are making well into the six figures for just not that many years out of school. Yeah. When you combine their stock grants plus their cash, so it's very, very hard to get talent. When you've got someone you think is an incredible athlete and can add a tremendous amount to the team, I often counsel companies within reason to add those one or two opportunistic hires. That's usually during the seed stage. Usually there's $2 million of cash invested at that point. Got it. Later on, you can get a little more opportunistic. You've typically got $7 to $10 million in cash. You can maybe do 3, 4, 5 of those. But I think you have to be opportunistic when the talent pops up. Yeah. Well, and the other phenomenon going on is there are so many startups that the pool of candidates is spread. There's 1,000 2-person companies instead of a smaller number of 10-person companies, right? Yes. So I can't do that math in my head. That's too hard. So Larry, hope that helps. Let's move on to Mark. What advice would you give on getting funded on a business that's going into a market where there's one big player that's overcharging for minimal features? Okay, I wonder who that is. How can I convince VCs that we can compete? What if the market has had some recent startup investments that lost a lot of money, making VCs even more reluctant to invest? I don't know if I can guess which sort of company that is. So it's a market with one customer? One big player that's overcharging for minimal features. I don't know if that's a Ticketmaster reference or it sounds like a monopolist sort of owning the market and then some startups trying to get in. That have tried to get in and lost money. I don't know, something like that, it sounds like. Yeah, VCs have been called lemmings before, and following the herd, and there's a problem in this business, which is that a typical venture guy will see 500 to 1,000 deals in a year, depending. Seed, you tend to see more because we're at the top of the sales funnel, so to speak. Yep. Guys typically around 400 or 500 a year. When you look at that many companies, you're looking for relatively quick screens that can help you weed through that much volume, so that you can get down to the ones that you want to take meetings with, and then so on. Because you've still got a portfolio of other companies you're supporting, so your day is not entirely free to just look at new stuff. Yeah. So one of the challenges, if there's been a space that's just been where startups have gone into it and just blown up over and over and over again, that tends to be a signal to a lot of venture guys that maybe I should avoid this. A couple tactics that I'd suggest. One is start with just a friends and family round because and potentially get some crowdfunding in it if you can. But most of the time I see a company today, it's already got 500K of capital in it. The seed round is no longer the first absolute capital that goes in it. Usually there's large sort of friends and family rounds that go on, and those are usually entrepreneurs guys you've worked with before. Maybe you have some wealthy family members, or you go to AngelList, or you do something else like that. You get enough capital together. Then you use that initial capital to really prove that you've got something unique and different in this market against this big incumbent that's in the space. And you prove that through getting your first 5, 10 customers. And even if it's on MVP, just using something. Now maybe if it's a more complex product, it takes longer to build. But typically, if you're very scrappy, you can build something that people will use and really show that they like, either through qualitatively, just you call them and you ask, hey, what do you think of this product?
Right. Or
through their usage and engagement metrics, depending if it's consumer or enterprise. So I tend to recommend that entrepreneurs do that. They try to get some data because you're pushing a rock uphill in this market, right?
Yep.
You said it's a market where people have lost a lot of money before, so you've got to show that this is unique, and then people can talk to that. There's nothing speaks louder to a venture guy than the customer, right? When you go and look at a market, and you're going to look at a market, especially a market like this where people have blown up left, right, and center, and you talk to 5 customers, and they all say this is the best product ever. It may not have all the features now because it's sort of MVP, but I see where it's going, and I would change all my business over to this in a second. These other guys don't have half the features or whatever it may be. So you have to be more scrappy in markets like that, but often they can be the most interesting markets, and you can win. The other tactic is you try to find an operator who's a venture guy, who knows that space, who's been in and around that space. That can cut both ways. Sometimes they're so done with that market that they're like, I'm never going to touch that market again. Sometimes they can they'll be really they'll pause and they'll listen. They'll say, oh, you've really got something interesting, unique. So those are some different tactics you can use.
No, that's cool. I like it. And it is hard to go up against these big guys. But one of the things I've noticed recently is a lot of focus on sort of mobile-first companies attacking the incumbents who maybe they built an iPhone app or something, but they haven't really focused on mobile-first, right? And there's a bunch of that stuff going on. So, so good. Well, let's see, who is that from? That was from Mark. So Mark, I hope that helps you out. And we're going to do one more here before the break. This one says, this is from Beth. It says, Pinterest has just announced a change to give employees with 2 years of service, employees, parentheses, with 2 years of service, 7 years instead of the typical 90 days in which to exercise any vested options. That's a cool idea. I did not know that. What does such a policy cost an employer, and will this position influence other companies? So I have not seen that before.
Yeah,
it's
that's
like
unique.
90 days is pretty typical.
It is. And it cuts against, the challenge with 90 days is, it's if you have the cash to exercise, great, you can exercise.
Right.
But often when you exercise, the current price is above where your strike was.
Yep.
So you're not only going to have to pay for the stock, but you have to pay the tax bill, which is often AMT, short-term income tax rate.
Absolutely, yep.
And so painful, right? Sometimes you have to write very large checks. And if you don't exercise in those 90 days, it's gone. Right.
Absolutely.
So, from an attractiveness to an employee in a competitive talent market, that's a really clever idea. I think it's unique.
Have you heard that other than this one, or?
I've heard. So it's come up a few times, and I'll answer the question, which is it's come up in a couple companies. A couple people ask me about it. Entrepreneurs are starting to say, "Hey, is this something we should do?" The challenge for the company is you want a cap table that's relatively stable.
Yep.
Because, as you know, you're going to potentially buy other companies. You're going to potentially raise more money.
Right.
You're going to potentially sell the company to someone else. And if you have a lot of the cap chart sort of unknown in this limbo stage,
because it could be this or it could be that.
Yeah, it's got a 7-year option, and it could be 5% of the company or 10% of the company, depending how long this has been going on for.
Yeah.
Then it's harder to, how do you establish what the price is for the stock, right?
Yep.
You have to assume that all that is going to be exercised, basically, when you're doing those transactions. And it can be hard from a company standpoint to manage the comings and goings of that. The other thing is just administratively, it's harder, right? You've just got, all of the overhead from that. I think it's an interesting idea. That I think that they did it is you're going to see, I'm guessing you're going to see more startups do it, especially because it's such a competitive market for talent today.
Yeah, I think it's cool. Maybe 7 years seems a little bit extreme in my opinion,
It's
but
long.
Maybe it's.
And the 2-year cutoff's an interesting idea, right? So they limit it only to people that are sort of now past the point where we know they're a fit, right, for Pinterest, and they're going to be here long term.
Yeah.
So it probably limits the, you limit the churn issue, people that come and go, they didn't work out in the first year.
Yeah. Makes sense.
Yeah.
All right, cool. Well, Beth, I hope that helps out. It's funny. There's all these tricks that you can play with. Single trigger, double trigger acceleration, like, who can early exercise. So I always tell founders to like really talk to somebody about, well, what are all the options? And like what's market? What have you seen that's kind of cool? And, I always try to be a little bit more on the generous side in terms of some of those parameters, because most of the time it costs the company nothing, but it really like early exercise for the early employees.
I love early exercise programs. I mean, I think they're, assuming you can keep that price low, where it's a relatively small check for people to write, then it's theirs, and then it changes the tax profile entirely.
No, it's great. And I think people who join startups are getting more savvy about that stuff, but there's still a lot of people who don't even know, and they go based on, well, my last company, I got 20,000 shares, and I'm like, well, what percentage was that? And you have this conversation, and they realize, I don't know what I'm talking about. And so, I really try to educate people on that, and crafty people like you and me, when we start companies, we capitalize with 50 million shares or 100 million shares, just so we can offer
more shares.
50,000 shares. But I always go through the process of at least explaining, okay, here's what this means and why you should care about how many shares are outstanding.
Yeah, I believe the same thing. I'd be very transparent and educate people about it, because what's surprising is it's just math. It's just fractions, and these are engineers.
Math is hard. Math is hard, Bill. You know that.
But for some reason, people think it's finance terms, and people I think lose it, but lose the conversation somewhere in there, or lose interest.
All right. Well, we're going to take a minute here to thank our sponsors. So sit back and relax. First, I'd like to let people know, we couldn't do this without the amazing support that we get from our sponsors. For this new season of FounderLine, we have 4 amazing sponsors: Oric, Square One Bank, Accretive Solutions, and Ustream. And so, first, I'll start out with Oric. I want to thank Mitch Zuckley and his team over there. I've worked with them on multiple companies. We're working with them on FounderLine. They've been awesome. And I always tell people, you want to have a great lawyer who can do your contracts correctly and make sure your employment agreements are tight, and your intellectual property and all that sort of legal stuff. But the most important function that I've found in the lawyers that I work with is that they're one of your most trusted advisors. They have been through what you've been through hundreds or thousands of times, financings or hiring and firing or whatever it might be. And so if something comes up, having somebody who's seen pretty much everything and maybe even written the book on certain things is really helpful to have that. So, Mitch and his team over there are really great at that stuff. If you want to find out more, you can go to their website. It's oric.com. Next, I would like to thank our new sponsor for this season, which is Square One Bank. And I've known the team over there as well for a number of years, Lori Lumenti-Gardi and Sam Bomick. And if you want to get in touch with them, Lori is the right person to reach out to. You can find her on their website or on LinkedIn. Again, with banking, you think it's a simple thing, and it should be like you want a bank that's going to take care of your money and make sure that everything's fine. But you also want, as a founder, you're doing 1,000 different things. You want to make sure it's really easy. So things like having good online banking software, or having a company credit card, which a lot of founders get in trouble. They put a lot of stuff on their personal credit card, and then someday to discover, oh shoot, I forgot to expense that, or maybe the company goes under and they have all this personal liability. So you want to talk to a banker about that stuff, and the team over at Square One can help you out with questions around that. You can find out more at their website. It's square1bank.com. It's square, the number one, bank.com. We also have another new sponsor this season, which is Accretive Solutions, and they are the leading business outsourcing firm in Silicon Valley. And I had to ask Martini, who's the person I've worked with over there, I'm like, what is a business outsourcing firm, Martini? Because I know you as my temporary CFO in my accounting function, and so that's exactly what it is. They take care of making sure your books are straight. You know, if you need them to handle payroll or setting up your bill payment, your AP, your if you get AR someday, accounts receivable, which hopefully everyone does. So, you know, a lot of times in the early days of the startup, you don't need a full-time controller or CFO handling that stuff for you. And so getting somebody who has done it, you know, a million times before, who is way less expensive than a full-time employee is very important. So check them out. Their website, it's Accretive Solutions, and their website is as-bos.com. So be sure to check them out. And then finally, many of you are watching this show now live over Ustream, and I'd like to thank Brad Hunstable and the team over there for being with us from the very beginning. They were one of our founding sponsors, and without them, we wouldn't be able to bring you this live show every week. Their streaming technology is the best, and if you need to set up a company meeting or some sort of event for your business, they can pull that off with ease. So go check them out. Their website is ustream.tv, and I'm sure they'll be willing to help you out. So that's paying the bills, as they say, as they say on TV. So we're going to go back to some questions now, and let me just take a look here and see what's going on. We have one from Michael here. Do you believe that Meerkat's success will diminish without the help of Twitter's social graph and Periscope will dominate? Or maybe neither of them will succeed and we are just experiencing the peak of the hype cycle. So first of all, are you investors in any of those companies?
We are not.
Okay, so neither am I.
I know the Periscope guys, great guys. Glad they exited. It was wonderful.
Yeah, it's amazing. Was a rumor about what happened there, or like the numbers, or yeah?
There are rumors. I don't know what's true or not.
I haven't seen any numbers, so.
Yeah, I've heard numbers all over the place, so I don't know.
Okay, well, we won't quite know. We won't speculate. So what do you think? Is Meerkat dead? A lot of people are saying it is, but I don't know.
So I'm challenged with this space a little bit. I think it's a little on the hype side. I'm in that camp. I think that listen, text is great. Pictures are great because they're quick, right? You can quick look.
Yep.
And you're in and out. Meerkat, Periscope are longer engagement, right? This is a broadcast I'm going to do now.
Yeah.
And I think that it's very novel right now. It's very clever. It's very quick the way you can engage with it. Or even if you look at Vine, which Twitter bought early on and launched, very short, right? 6 seconds and you're in and out.
Yeah.
I think that it's the format, and obviously, I could be completely wrong with this, but I just didn't think the format is well suited to the longer form. Live broadcasts like this, or this is obviously very long form, but even for a 3 minutes type of interaction, I think people are in and out very quickly. And I know they designed it that way so that you can come in and out. Yeah. But you sort of miss part of the story, you miss part of the engagement that way. So I tend to be a little more on the hype side. Where are you?
Well, so when Meerkat came out, I just saw it exploding, and it was all over my Twitter feed, sort of like droppings on my Twitter feed is the way I thought about it. And so I was slightly annoyed, but what was amazing to me is like somebody could launch, a stream and in like seconds have 1,000 people watching it, right? And a big part of that was the power of the Twitter social graph. Yes. It seems like Periscope is less obnoxious in that way, right? I think they're maintaining their own graph, which is built off of the Twitter social graph, but they're not spamming everybody's Twitter feed as much. And so, it's funny, right before the show, I did a little tour of the studio and just to see, to see what would happen on Periscope. And it was amazing. I mean, there were like 50 people in seconds, and like people asking me questions about TV technology and startups and like whatever else. And the hardest part I find is the interaction, because you're broadcasting, and then you're trying to read the questions and also go around. I've seen people driving cars who are doing this, which is just like absolutely crazy, right? I'm sure there'll be a law soon. That no live streaming video. I don't know if that's covered under
unless it's a self-driving car.
Yeah, maybe. So I don't know. I think it's early.
Yeah.
But what I've seen, like Chris Sacca this morning, and I think he's been doing this for a couple weeks now, is a couple days at least, is he'll do office hours on the beach.
Yeah.
And so he's just walking down in Manhattan Beach, and he sits at the lifeguard tower, and he'll just field questions for like a half hour. And he's getting hundreds or thousands of people doing that. So now obviously he's a big holder of Twitter shares, and so
yes.
he's promoting it. But I don't know. I don't know where it's going to go. I do think I think Meerkat is going to have to pivot quite a bit. And what's funny is Josh Ellman, who's probably friends with you as well. Like he was at Twitter. Meerkat comes out, explodes. Josh invests, which I'm sure was going on for some period of time, and then Periscope gets bought, and then Twitter launches it earlier than they had thought originally, and so like all this stuff like within 2 weeks, like it was just like this crazy moment. So
it's amazing how quickly it took off.
I don't know. I'd love to see their numbers, but we'll find out at some point. So Michael, I hope that helps. We'll see at some point. What happens. Let's see. Here's one from Luis. How long does it take you to make a startup investment? I've heard of people writing checks after 15-minute phone calls. Yes, that is happening. It's crazy, and that seems like a bad idea. So Luis, I think you're right. So
yeah,
how many checks have you written after a 15-minute phone call? That's the real question. That's what he wants to know. I'm guessing 0.
The only case where I don't think I've ever written one in 15 minutes.
Okay.
But
20 minutes?
Maybe 20. So the only case where that happens is where I know the founder well, like we've worked together, old friends. You might put Scott Bannister and Scott Weiss in that category for Ironport, right? It was a bet on them, right, more than anything. It was so early. But if it's a bet on the team, you can make a very quick decision, especially as an individual. As a firm, it takes more time. We always really like to understand. This is what makes YC a challenge. We like to really know the founders well, and so we do even with YC, we do some extra work just to who do they know that we know, and what do they say about them, and so the
are you doing like backdoor references?
Yeah, the backdoor reference is it frankly, thank you LinkedIn. It's incredibly
it's awesome.
It tells you a lot, right?
Yep.
And so that's the type of data we like to get. That's incredibly telling. But 15 minutes, it's hard to really know. You can know what product they're building, maybe what problem they're solving. It's hard to know much else, right? You can't need to cover how they're going to market, how they're going to build their team, how they think about things. So it's usually several hours, with each founder, one-on-one, over meal, that sort of thing, that you really get to know them. And it takes the typical process, I would say, takes 2 to 3 weeks, usually 3 weeks, from initial meeting. Liked it a lot. The initial meeting is usually an hour, right? So we have a conversation for an hour. Then it's go do a bunch of diligence, have them bring another partner in, have them meet another partner, then talk to that partner about that. That's another hour typically. Then go do a bunch of continue due diligence, and this time you're doing diligence on market and team. Typically at our stage, you're looking at the product, but the product's usually very early for a seed stage investor.
Right.
And then if all that's coming together well, we look at it as a partnership, and we bring it into the partner meeting.
And that's probably another hour.
That's another hour.
Something like that.
And
in between, probably lots of phone calls, clarifying meetings, the business model or whatever.
Figure you're spending for the average founder 6 to 8 hours with them before making an investment.
Yeah, and that's what's so hard about this compressed time frame. But I tell people it's in your best interest. They
should know us. Absolutely.
Well, and it's amazing how many founders don't bother doing reference checks on their investors. And like this whole week, I've been telling people, have you called any CEOs? You need to call some CEOs and find the CEOs who got fired.
Those are the ones we're talking about.
Or
where it didn't go well.
Yeah, and bad things always happen, but at least you should understand why it happened.
That's right.
And I'll discover somebody I know took money from maybe a VC I'm not that excited about, and nobody at first round, of course, Josh. But I'm sure he's watching right now. That's why I just gotta keep. You guys send him the link later, just so he sees all these ads. But they just don't bother. They don't bother checking.
No.
And I'm like, oh my God, I could have saved you so much trouble. And I had the first situation where, like, a guy had taken money from somebody who I think is a bad actor, and I'm like, I can't believe I'm going to say this, but I love what you're doing, and I'm not going to participate. Like, he gave him
Because he was going to be the lead.
He gave him a board seat.
Yeah.
He put in like $25K and gave him a board seat, which like further demonstrates that he's a bad actor, right? And I was just like, you got to be kidding me. I'm like, he really shouldn't have a board seat. Like, you're doing I think it was like a $500,000 round. And somebody puts in $25K, they don't get a board seat. Like, that's just not cool. And so, yeah, I don't know.
Well, yeah, I mean, it's so important. And when our companies go to A, I tell them the same thing. Do research beforehand. It's weeks ahead of time, weeks before your first meeting. You should be doing research. You should be calling other entrepreneurs who funded companies that look like yours, right? That have similar business models.
Yeah.
And what do you think of your guy? What do you think of this guy? Who do you recommend? Who else did you talk to? Who really impressed you? What did they do when times were tough, right? Like, you must have had a tough board conversation or two. You had a bad quarter. What happened?
Yeah.
And when it was tough to raise, or good one is it's tough to raise an outside round. What did they do? Were they there with money or not? And those are the types of things that you really got to understand about your investors beforehand. And I always recommend entrepreneurs do it. Not enough do.
Let me ask you, and you don't have to answer this if you don't want, but do you guys at First Round, do you have software that helps you? So, like, do you have a database of all the people you've talked to, and like, reference check didn't go well, Rob Hayes, or like whatever, so that, like, if the person comes back in the next time, like, do you keep track of that stuff? Or
so we're better at tracking companies than we are people, I would say.
Okay.
We certainly track companies over time. It's actually very interesting to see how often the same company comes in through multiple partners.
Oh, really?
Yeah, and we're a bi-coastal firm, so it sometimes comes to a West Coast partner and then an East Coast partner.
Like the same week? Like,
yeah, week or two apart.
Yeah.
And it's entrepreneurs, when they're out there getting their seed round, they're getting a lot of introductions through people, and sometimes it's a completely innocuous mistake. Sometimes it's they think they're just try another door. So we track that, and that's very easy to spot for us. But not so much on the other stuff. It's almost too many data points for us to track.
Yeah, no, it's tough. Even happens with FounderLine invitations. I still have trouble thinking of you as First Round. Like, I think of you as Bill, right? And so Bill and I had said, well, we're going to do this at some point, and then I was looking through something, and I'm like, oh, Rob, I should invite Rob. And he's like, well, you got Bill coming on.
Yeah,
like,
you're covering.
This isn't the First Round show. So anyway, that was pretty funny. I didn't even think about that. I'm like, oh my God, he's right. So we'll hit Rob up another time. Yeah. So all right, well, let's keep going here. I don't know if you realize it. We got like 12 minutes left, so we're gonna pack in as many as we can. We have Bobby. It says, as a startup founder CEO, how did you structure your day? How did you make sure you're focusing on the right things every day? This is a great question.
It's a great question.
So let's hear the secrets of Bill on how you do that.
It's tough. So as I made a lot of mistakes along the way, and I've learned a lot from watching other entrepreneurs do it. And so I'll tell you more what I've learned to do right, both from my own mistakes. And so I did some of this, and I haven't done all of it. So one is I think it's so easy in this world where you're bombarded with so much coming in. You got email coming, you got Twitter feeds, you need to be a public presence, you got to speak somewhere, you got to recruit some candidate. You got so many demands on your time, especially as a CEO. Yeah. To really make sure you're moving one thing forward every day, and like very clear, concrete. You've got your most important thing, and then sort of 2 and 3 after that. And I think it's very hard to do more than 3 that are really kind of needle-moving things. And I believe that in terms of structuring day, you do this first thing in the morning. There's a lot of research that says, like, if you're going to write something, you got to make a presentation, or you got to do anything creative, you're most creative in the morning. It's when you have the most reserve of energy. You don't wait for the end of the day. You do it in the beginning of the day. So block off the first 2 hours of the day, right, 8 to 10, and just leave that as your time. Not to do email. Do email after that, right? Don't touch email It's very hard to do. I fail.
Do you succeed?
I fail all the time. I
Yeah.
try not to, but you know, the iPhone still sits at the bedside table, and you know, you pick it up a little too easily. But you try to block that time off, and you go in and you do your project or whatever you need to do, and then you get on with the rest of your day. That's sort of number one. Number two is making your meetings really effective. I've found to be you know, a big challenge especially for new CEOs, where every meeting that you're coming into, it's very clear what you're there to do. What's the agenda? What are you going to discuss? What decisions need to be made? What are the outputs? Who owns what at the follow-up? When's it due? That sort of thing. And then bringing it back to like, did those things get done? And is accountability driven through the organization? That sort of basic process of a management meeting, for instance, is, you know, more than half the time people don't do it, right? It's just a little, it's loose and so on.
Well, especially in the very early days when it's like 5 people
it's like
or whatever.
5 guys. And you don't even know when's the point that you put that process in, right? So I recommend, you know, sort of getting that clarity earlier, because you can spend a lot of time in meetings and suddenly you're like, why are we having meetings? And then you have meetings about meetings, and then it's, you know, it sort of falls apart. So structuring your meetings the meetings that you do have really well, make sure there's very clear outcomes from each is really important. Specific on management meetings, I'm a big fan of the Jeff Bezos method. Do you know?
No.
You know this?
Well, maybe I do, but remind me.
Where he, once you have a team of like, say, 5 people, you got someone running sales, product, marketing, and so on, you do all the updates written down.
Ahead of time. Yeah, he's a big Microsoft Word fan, right?
Yeah, so like people write their update and then their metrics are in there. Maybe it's like a paragraph or something like that. And then on your Monday morning, you spend the first 10, 15 minutes reading it, right? And that's your blocked time. Right. Because status meetings are the worst. And there's so many meetings are status meetings, yet they waste so much time. Yeah. Because all that data can be communicated much more efficiently through, you know, something written down, and you can write some questions in the margin, then you can ask the questions. Versus people are not very good at, you know, being succinct and being like, I'm not being succinct right now. Like, you know, just you drag and you just sort of like go on and on and on. And then they don't realize it's taken 30 minutes to cover their area when it could have taken 5. Yep. So that's another thing I think is really important. You know, and then limit email. I'm a big believer of batching email. Like just batch it to do the 30-minute, hit it, try to get to inbox 0, move things that are tasks out of your inbox, move them into...
Touch it once.
If it's going to take you more than 2 minutes, if it's less than 2 minutes, handle it then. More than 2 minutes, either delegate it or throw it in Task Manager. Throw it in, one I've been using recently is Handle, which I like. It integrates well with Gmail.
I need a new one.
Yeah, there's always new ones going around, but move it into some Task Manager, you can come back to it later.
Cool. And you know, Brad Feld has this theory, like it's amazing how meetings always end up being 1 hour, you know, and they expand to fill the space available, like hard drive space, right? So so like he'll schedule meetings that are like 15 minutes, you know, and he'll warn the person in advance, and like, you know, there's no chit chat when you sit down, and it's like, why are we here? You know, and I mean, on one hand, it's a little ruthless, like maybe a little socially awkward for everybody. Yep. But on the other hand, you know, I especially find this with when you're having a coffee meeting with like somebody who asks you for a favor, right? You know, and they kind of expect you to spend the full hour, and I'll warn them in advance as like, you know, I'm really busy. I will give you whatever, 15 minutes or 30 minutes, and then I give myself the option to keep going if something interesting is happening. But that really helps to, like, every meeting doesn't need to be an hour.
That's right.
You know, you can have 15-minute meetings.
Absolutely.
And in fact, those are the best, right?
They are. Plug for this, I actually did a piece on First Round Review about this, so you can go to firstround.com/review, and there's a piece in there on productivity. I interviewed a whole bunch of CEOs to see how do they manage their days, and there's a lot more tips in there. But
cool. And by you know, that First Round Review, the content there is awesome. Like, I don't know.
We have a great team.
Yeah, I mean, there's a whole team of people who are responsible for putting together the technology and the content as well. So, you know, I subscribe to that. You know, you should subscribe to that. There's so many great resources now where lots of, you know, old entrepreneurs are coming back and like writing down the stuff. I mean, Naval and Nivi with their angel hacks way back, you know, before AngelList even. I mean, I just like consume that stuff, right? So
a lot of good content, and we're big on tactics, right? So a lot of that's really the how-to. You know, like, yes, you need to go to market strategy, but how do you build your first sales team, right? And what do you look for? That's the type of stuff that you'll see on there.
Absolutely. All right, so here's one from Michael. Do you believe that all original angels and early stage VCs should receive pro rata rights if they want them? Great question.
Yeah, it is a good question. I think if an investor's backed you early and has taken the risk to put their money where their mouth is and put money in when it's just an idea or it's relatively early in your life cycle, and they believed in you because there's so much in a belief in the founder and in the company, and they want to continue to believe in you and they want to continue to put their money there. I do believe that pro rata rights.
Even like for the 25K investor versus the 500K investor or something like that, because frequently
they don't, right? So most seed investors don't that put 25 or 50K in. They don't take their pro rata in the next round because they're not reserved against it, right? So we reserve a fund. Most funds reserve for follow-on investment, where you're reserving 50 to 70% of your capital, actually, for one company in follow-on. And individuals don't do that. So for individuals, I don't think it's as important, but I would ask them. I would make it at their option, right? And these are it's a long-term relationship. If someone wants to continue to back you, it can almost always be worked out. Right, so where it becomes a challenge for because every follow-on investor, the Series A investor, is expecting that the guys are going to put follow-on money in, and if they don't, it's actually a bad signal.
Absolutely.
So, so everyone expects it. So you can usually make it work out if there's not enough room for things to happen. We've never had a problem with it, and like you said, mostly the individuals don't do it.
Awesome. I have a great story. Just quickly, there was an investor who came in late to one of my previous companies as an angel, and they didn't put in that much money, but they insisted upon pro rata rights, and I had to go back to like 10 other investors, like get them signed up, and then when the time came to do the Series A, they didn't want their pro rata rights. And I'm just like, are you kidding me? Like, after all that trouble you put me through, you're the one who decides not to? And it's like, well, we had got some stuff going on. Like I think there was some fund management stuff going on, like where sometimes funds run out of money, right? And they can't do it. But I'm like, okay, I'll remember that. Thank you so much. All right, let's see. We got a few more here. Tim, how many partners at first round are required to make an investment? Does it have to be unanimous? How many partners are there now? 7, 10?
There are 6.
6. Okay.
One of those is part-time, which is Howard. Howard's on the East Coast.
Okay.
So we don't disclose how we exactly make decisions.
Okay. All right.
I would say that it is. There's some. It's a discussion. Every time it's a discussion, we go around the table, get everyone's viewpoints on the company. We debate. It can sometimes be a very long debate, and you're debating the merits of the product, the market, the team. You're looking at all those factors and then making a decision.
So 62%, that's the number, isn't it, Bill?
There's a number, but I can't. I'm sworn to secrecy on that one.
All right, that's cool. And I actually think that's one of the hardest things as an angel is you don't have a group to go back to and like get slapped around like, what are you thinking? You know, haven't you looked at X? And you're like, oh my God, I totally forgot that, or whatever it is, right? So that's the beauty of a partnership is being able to do that.
That's right.
Yeah. And I I've heard from other people that, especially in bigger firms, like some of them are unanimous. It has to be unanimous. And if you're gonna say no, like you gotta be careful because that could come back to haunt you someday when you're bringing an investment and like guys like, well, I'm gonna get even with that guy, and those perhaps are dysfunctional partnerships to begin with. But anyway, that I think that's pretty typical.
We believe that the group has tremendous power, like to your point, right? Which is that when you get a group of people on looking at a company, you make better decisions as a group, and I believe that very strongly. It's one of the reasons I'm doing this as a partnership.
Cool. Well, unfortunately, we're out of time, so we couldn't get to all the questions. Sorry to those of you who we didn't get to, but maybe we'll try and answer these next time when we get together. So anyway, thanks for doing such a great job.
Absolutely.
You can find Bill on Twitter. It's at @Trenchard, and First Round is @FirstRound, right?
Mm-hmm.
So go follow him on Twitter, and you'll get more wisdom like you've heard today. We are going to be off for the next 2 weeks for spring break, but we're back on April 22nd, and we'll have another great episode for you then. Our guest will be Mike Cassidy, who is now Vice President and Project Leader for Google X's Project Loon. That's the crazy project where they're putting up these balloons and delivering internet access to the remote reaches of the planet. So Mike's just an awesome guy. I've known for a long time, and he has a great history as an entrepreneur with 4 companies: Ruba, Xfire, Direct Hit, and Stylus Innovation. Back with some other MIT friends, and it'll be a fun show. So be sure to send us your questions now. Maybe we'll handle some of these, but if you have questions about startups, Mike's a great resource. That'll be Wednesday, April 22nd at 5 o'clock Pacific time. Thank you once again to our fantastic sponsors, Oric, Square One Bank, Accretive Solutions, and Ustream. Don't forget to follow us on Twitter. Our handle is @FounderLine. You can send your questions to help@founderline.com. You can check out our website. You can guess the URL. It's where you can subscribe to email updates and even subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next time.